All right, welcome to this explainer. Today, we're taking a really focused, deep dive into one of Europe's absolute healthcare heavyweights, Roche Holding AG. Now, if you've been keeping any sort of eye on the markets lately, you already know Roche has been on a completely wild ride over the summer. I mean, they're up over 50% in just the last 52 weeks alone. But we don't just blindly chase a rising chart here. We need to dissect the actual data. We really need to figure out if this massive momentum is actually sustainable, or honestly, if we're just walking right into a trap.
Here's our roadmap for today. We'll start with the 50% surge, unpack their financials and valuations, look at how they're building a U.S. edge, dive into the Giredestrant catalyst, weigh the bear case risks, and wrap up with the final investor verdict.
Okay, Section 1, the 50% surge. Is this sustainable momentum or a trap?
Let's get right to the current state of play. With the stock jumping 50% in a single year, we've really got to ask ourselves a pretty serious question. Is this an undeniable long-term growth story that you absolutely want to be a part of? Or is it just a classic buy the rumor, sell the news scenario? You know, the kind of setup where savvy investors are quietly cashing out right before the big announcements drop. To figure that out, we have to look way past the stock price and dig into the actual business fundamentals.
Moving right along to Section 2, Financials and Valuations. Let's look under the hood.
To really answer our question, we have to start with the foundation. Let's look at their verified August 2026 data. This perfectly highlights the current reality of their sales performance versus the broader global economy. In the first half of the year, their underlying sales actually grew a really solid 6% at constant exchange rates. That is a fundamentally healthy business. But in actual Swiss franc terms, their reported revenue actually dipped by 2%. Why the disconnect? Well, it's because the Swiss franc has been incredibly strong. This is a massive forex headwind that you've got to understand. If you're a U.S. investor, you need to keep a very close eye on currency impacts, because right now, foreign exchange is taking a very real bite out of their reported top-line numbers.
But here is the kicker, and this is absolutely crucial. Roche is a total financial fortress, highlighted by a staggering 38% return on equity. Think about that for a second. Despite the currency headwinds, a 38% ROE tells you that management is just relentlessly efficient at squeezing profit out of the company's net assets. Financially speaking, the legacy business is rock solid.
So how does all this translate to their valuation today? Well, right now, Roche is trading at roughly 15.5 times its estimated 2027 earnings. That is a 15% premium compared to its European peers. The market is clearly looking ahead and pricing in a lot of future success. But here is the silver lining for income investors. While you're waiting for that pipeline to mature, you are getting paid a very healthy 2.7% dividend yield. They recently bumped their dividend to 9.80 Swiss francs per share, which is a super manageable 52% payout ratio. So you've got a highly profitable fortress literally paying you to wait. But let's be honest, the legacy business isn't why the stock surged 50%. The surge is all about the future. Which brings us to Section 3, Building the U.S. Edge Through Strategic Manufacturing. Back on August 20th, Roche subsidiary Genentech announced this massive strategic move that really deepens their competitive moat. They are pouring an eye-watering $750 million into a brand new manufacturing facility in Hillsboro, Oregon. That is a gigantic capital allocation, and it signals a very deliberate pivot in their global strategy. Now, why does a new factory matter to you as an investor? Two huge reasons. Step one is supply chain resilience. By doubling down in Oregon, Roche is localizing the production of super high-demand items, like pre-filled syringes and auto-injectors. This totally insulates them from global shipping bottlenecks and any potential U.S.-Europe tariff wars. Step two is tax and revenue efficiency. They are aiming to start commercial ops by 2031, creating 450 jobs, including 250 permanent, high-wage ones. In today's political climate, having domestic production gives Roche a huge, tangible edge when it comes to locking down highly lucrative U.S. government contracts and clearing reimbursement hurdles.
All right, Section 4, the Giredestrant catalyst, the absolute crown jewel.
The thing is, factories are only valuable if you actually have products to make in them, right? Enter Giredestrant. This is their next-generation breast cancer drug, and it's the exact catalyst every Roche investor has been holding their breath for.
Back on August 7th, Morgan Stanley upgraded them to Overweight, and the forecasts are just wild. They're projecting first-year sales somewhere between $800 million and $1.2 billion. But the really staggering number, the peak sales forecast is an unbelievable $11 billion. I mean, that is the literal definition of a blockbuster drug. That $11 billion is the core engine driving all this current market optimism. But hold on, because those billions are absolutely not guaranteed yet. You are going to want to circle these deadlines on your calendar because everything hinges on them. November 30th, 2026 is the FDA decision for adjuvant breast cancer. Then, just a few weeks later on December 18th, 2026, we get the FDA decision on metastatic breast cancer. If those two Q4 approvals go through without a hitch, that 15% valuation premium we talked about earlier, it's going to look insanely cheap in hindsight. But if there are delays or, heaven forbid, a rejection, this stock is going to face some brutal downward pressure.
That perfectly tees up Section 5, the bear case risks. Let's come back down to earth for a minute.
Look, Roche is an incredible company, but there are no sure things in the market. We have to impartially weigh the downside. Morgan Stanley laid out a bear case scenario where the stock had dropped significantly, down to around 300 Swiss francs. Why? Well, three main risks. First, continued currency headwinds. If that Swiss franc stays aggressively strong, it's just going to keep eating into international earnings. Second, fierce competition. Breast cancer treatments are a highly lucrative space, which means it's heavily contested. Giants like Pfizer and AstraZeneca are fighting tooth and nail for the exact same market share. And third, execution risk. Scaling up a $750 million factory while simultaneously trying to launch a blockbuster drug is a massive logistical headache. Any little stumble here could cost them critical early momentum. Fortunately for us, smart companies don't bet the whole farm on a single drug. Roche mitigates those execution risks with a really heavily diversified pipeline. If Giredestrant stumbles, they've already got Plan B and Plan C queued up. You've got afimkibart for ulcerative colitis, which has a peak sales guidance of over $3 billion. And then there's trontinemab for Alzheimer's disease, with analysts seeing a peak potential of over $5 billion. Having a deep bench of potential blockbusters like that provides a fantastic safety net for the company's valuation. Let's bring it all together in Section 6, the final investor verdict, synthesizing the data. So, synthesizing everything we've just covered, here is the playing field according to Morgan Stanley. Their base price target sits at 410 Swiss francs. Now, if we see a slow launch for Giredestrant or some pipeline setbacks, we could slide down to that 300 bear case. But if the FDA comes through this November and December and Roche totally nails the market launch, we are looking at a major re-rating. That could easily push the stock toward a 460 bull scenario, which would launch it straight into record territory. Ultimately, when you step back and look at the whole picture, Roche offers something incredibly rare in today's market. It is a high-quality, low-beta asset. We're talking a beta of just 0.35. That means it doesn't swing wildly every time the broader market panics. It gives you incredible defense against general volatility, mostly thanks to that massive 38% ROE in the solid dividend, but it still packs this enormous, aggressive growth potential through its multi-billion-dollar pipeline. So, if you're taking a long-term view heading into the end of 2026, the risk-to-reward ratio here is just fascinating. But at the end of the day, it all comes down to your own strategy. Keeping your position sizing in check and keeping one eye on those Forex markets, I'm going to leave you with this. Are you confident enough in that 38% ROE and their massive U.S. expansion to buy into the underlying fundamentals today? Or are you playing it safe, waiting on the sidelines for those critical FDA announcements to clear the path? Weigh the risks, watch the data, and thank you so much for joining me for this explainer.